Good afternoon, everyone, and welcome to our latest CIBS Lunch and Learn. Today's topic is commercial mortgages, products, pitfalls, and premier trends. Today's special guests are Davy Serpelis, Senior Vice President and Business Banking Manager at City National Bank, and Josh Silverstein, Senior Vice President and Interest Rate Risk Management, also with City National Bank. Davy Serpelis opened City National Bank's Melville office in December of 2017. As Senior Vice President and Business Banking Manager, she leads a team of experienced business bankers providing advice on best practices with solutions to grow and protect family businesses, including financing, cash management, investments, and international trade. Ms. Serpelis has 30 years of commercial lending and banking experience. Prior to City National, she was Senior Vice President with Astoria's Long Island Business Banking team. And previous to that, she was Senior Vice President on Citibank's Long Island Business Banking team. Ms. Serpelis has served various non-for-profits, including the Book Fairies, American Heart Association, and Jericho Public School. She is co-founder and secretary of the board for Middle Market Alliance of Long Island. She has been awarded the Long Island Business News Executive Circle of Excellence, Long Island Power Woman in Business, and Top 50 Most Influential Women in Long Island. Josh Silverstein joined City National Bank in 2009 in the beginning of the IRRM department to help grow the business. Josh has 15 plus years of capital markets experience, primarily focused in interest rate derivatives. Prior to joining City National, Josh worked at GE Capital Finance in their interest rate derivatives group, and prior to that, started his career at Key Bank in their National Banking Group rotation program, working in investment banking, real estate, and interest rate derivatives. Josh earned a bachelor's degree in business administration from Ohio University, majoring in accounting and finance and economics. During the presentation, please feel free to submit questions at any time via the Zoom chat feature. And please join me in welcoming Davy and Josh. And guys, please take it from here.
Well, thank you very much, Leo, for that kind presentation of our bios. Good afternoon, everyone. I hope everyone's staying cool on this very hot, sunny Long Island day and getting ready for a great long July 4th weekend and celebration. We're going to try to make it interactive. So if you have any questions, like I said, please don't be shy to raise your hand or typing into a chat box, and one of us will try to grab them. Hopefully, we're going to teach you something today that's going to help you close more business and give you some insight as to why deals stall. Okay, so just some highlights, and I don't know who on the phone is been doing this 30 40 years and who's been doing it 5 minutes. So we try to keep it high level and not too granular, and go into some of the basics as well as some of the more detailed high level information that's important to understand. Everyone on the phone is trying to sell real estate, right? Or you're trying to lease real estate or something of that nature. And one of the things that comes into play that is very important is finance. There are people out there that buy for cash, but not everyone has that kind of money or wants to use it in that way, and they prefer the leverage. Those mortgage products are really important. City National Bank, for all you don't know, I won't go into a deep thing right now because of time, but I encourage you to look at our website and just kind of see the history of the bank. The reason I joined this bank and opened up the office is because I needed a just right bank, just right for you and just right for your clients. So we could accomplish closing in a timely fashion, that we can be transparent, we can be educational in nature, and we can be client first, and that's what we're all about. So hopefully we're going to do that for you too. Talking about mortgage products, there's conventional, SBA, and a CRELOC, which is a commercial real estate line of credit. Those are the main products. There's always hybrid things out there in the market, and some of you might work on really big transactions and do CDOs and CLOs and CMBS. But we're going to keep it simple today. We're going to focus on that kind of lower middle market and middle market. Those in Long Island mostly deal with that, right? The 6,000 plus closely held small and middle market businesses in Long Island, at least that I'm aware of. And, typically the main purpose is to finance real estate. There's, property purchase. We're seeing quite a lot of that today. Refinancing, which also becomes attractive where the Summons mortgage is up, or they see it at lower rate opportunity like you're seeing for the past years and currently. A cash out scenario because they have equity in their real estate that's appreciated and they want to use that for their business or family. A business acquisition that has real estate tied to it. Seeing a lot of that as well. We'll talk about that a little later. And partner family buyouts, also pretty prevalent right now in the market, kind of a theme. So talking about conventional owner occupied is usually our theme because that's what we mostly focus on at City National Bank. We're really a relationship bank. I'm sure you've heard the term before. We really mean it. We are not transactional. We are not just trying to book assets. We're not going to package them into the secondary market, the CDOs and CMBS. We are a portfolio lender. We focus on owner occupied. We focus on entrepreneurs and family-owned businesses. And that's not to say we don't do other stuff. We have a real estate lending group. They do 10 million and up deals for, A-class developers that are doing ground up. But my team, which is part of personal and business banking, focuses on the smaller middle market, which most of you play a lot in, focuses on owner-occupied real estate. And what does that mean? 51% or more is owner-occupied. That means that cash flow from that operating business is really what's going to debt service and be underwritten for that loan. And typically, most banks will go up to 80% loan to value as a maximum conventionally, right? We'll talk about SBA in a minute. And that depends on the real estate class. So some banks, usually tertiary small banks, regional or locals, they might like to get into some alternatives. They book some business, land, or golf courses, or gas stations, and all that kind of jazz. But as an $80 billion bank and owned by one of the largest financial institutions in the globe, Royal Bank of Canada, we're keeping it clean here. We're not doing those high risk properties. And if we were to find ways to do it, and sometimes we do, we've done a golf course, we've done a temple, we've done other things, but it's usually tied to a very high net worth individual that's a banking client of the bank, and there's a value proposition there for us. And those type of properties will certainly get a lower LTV. But your plain vanilla, owner occupied, manufacturing, warehouse, wholesale distribution, all those kinds of companies, even retail, maximum 80 loan to value. Talking about rates. So there's an ARM product, everyone's heard it before, a 525, a 725. There's, fixed rate products that usually people like to go into, mostly a 10-year fixed, a 15-year fixed, a 1020 or 1025. There's those ARMs that have those rate resets built in. So it could be a 725, and in 7 years it resets at the basis, and then it goes in another 7 or another 5. And then there's one of my favorite products, which my subject matter expert colleague, who was kind enough to get on the phone with us very early in the morning, Josh Silverstein out of California, he's going to talk about in detail later, a swap. And that's a pretty unique product that is a great product for a client in a low interest rate market like we've been in for a few years. Prepay options are typically fixed, yield maintenance, or that swap. So fixed, everyone I think knows it's that 5544332211 or 54321. It stays at 1 for the perpetuity of the loan. Is something called yield maintenance. And to keep that simple, it kind of means if you were to break a product early, it's a 10-year fixed rate, and 5 years they want to sell the property, refinance it, whatever, and they're breaking into a fixed rate term loan. If rates went up and the bank can reinvest money at a higher rate, the prepayment penalty is going to stay pretty low. So it kind of controls it in a rising interest rate environment. It's a pretty good product. In an interest rate environment that might be going down, probably not the greatest thing. You want to stay with that fixed. And some people are just risk averse and they don't like the unknowns and they stay with the fixed. We do a kind of a blend here, fixed, yield maintenance, and swap depending on client. And as far as that CRELOC, that commercial real estate equity line of credit, sometimes it's there for an unencumbered property with no mortgage. Other times it's a second if it's a low LTV on the first. It really is just a line of credit against the value of the real estate, kind of similar to a typical mortgage up to 80%, and allows some flexibility to the client. They want to borrow for home and, for improvements, for operating capital, so forth. So one of my favorite products out there is the SBA products, the 504 and the 7A. Those are only for owner occupied. The SBA does not finance investments. And if, for those of you who don't know it, the reason is because they're trying to help business grow, job creation, and tax payments. It's just a unique product for business owners and operators. The 504 is typically the one you use for real estate only, or real estate and some improvements and equipment attached to that real estate. It's a better product for that, but the 7A can sometimes be used for real estate. So I wanted to mention it. So the 504 is typically purchase money, which means it's acquisition financing. It's not typically used for refinance in some certain circumstances, but we won't go that deep into that nitty. But it's typically someone's buying a piece of real estate. They don't have that much money down, or they only want to put 10% down. They get 90% financing, which can improve improvements, closing costs, etc. And what's really cool about this product, and it's so misunderstood, is that it really doesn't have a total of higher fees than conventional. Someone gets 90% financing, and actually, after including closing costs, they're at 92% LTV on average, which you can never accomplish without the SBA program. Now, refinances, sometimes, as I said, that happens, but I'm not going to go too deep into that. And then we have the 7A product, which means the bank gets a 75% guarantee from the SBA. Typically, that's really used for working capital, buyouts and acquisitions, so term loans and equipment. Once in a while, it'll be used for real estate, and really more often in the small deals that are like 250 and under, and someone needs it. The banks will tend to go with that product for those small deals versus the 504 for a lot of reasons, actually. Just giving you a little bit more details in SBA 504. We talked about the maximum LTV 90. It really ends up being two loans. It's a 50% first deed trust with the bank, in our case, City National. And then there's a 40% second deed trust with a CDC, which is, Commercial Development Corp, which really is a partner to the SBA that underwrites and holds those and packages them into the secondary market. So we close the whole loan, and then typically we sell off the 40% to that CDC SBA. Project sizes are up to 20 million, potentially higher on a case by case. That's interesting to talk about. And the minimum project is $500,000 typically. We talked about terms before. It's very flexible. You can go up to 25-year maturity, 15-year fix, sometimes even a 20-year fix. It just depends. And same with the CDC. And I really do need to update that rate, but that's a little stale. I missed that. But the rates are really favorable, much lower than you see from December 2017 at 4.5. They're quite lower now, and really controlled, which is nice. And the one thing that's really cool is the client doesn't have to pay the mortgage recording tax on the 40% piece. So that saves them the money that offsets the fee from the SBA. So while people think the SBA is a more expensive product because of the fees, it is offset, and it really isn't more expensive quite at all. Long prepay is really attractive in the SBA product, and often no additional collateral is required other than the PG of the company. Here's a little bit on the 7A, just a maximum loan of $5 million. There's up to 100% financing for equipment, inventory, working capital, which is pretty cool, and 90 on real estate. So if they're blending up a deal, they could end up at 95, 96% financing, which is frankly unheard of. Now, if it's a business acquisition, SBA does want to see a higher down payment in it, but that's on the non-real estate piece. And there's a variety of ways you can use this as we talk about tenant improvements, fixed assets, real estate, debt finance, all different kinds of things. There's no prepayment penalty except for on commercial real estate. So that's kind of cool for them too. And the guarantee range is what people don't like. It's 1.5 to 3.75% of the loan. So that tends to be a little bit upsetting to those, but that high financing is well worth paying that fee, frankly. And depending on the risk profile of the client, it could require life insurance or even a second springing lien on their home real estate. That is often a deal killer for your borrowers. They don't want to put up the real estate, and typically the spouse of the business owner doesn't want to allow that. And that's often why the deals get killed and they don't end up doing SBA. And if they need that SBA financing because it's a high leverage need, 10% down only, ends up killing the deal completely. And in my 33 years in business, I've seen a lot of deals killed because the spouse doesn't want to allow that, and the SBA does require it. Something I always like to talk about and present to you, and I could share this slide deck with you and allow you to use this when you're talking to clients. Why lease when you can own? If you use an SBA product and you only have to have 10% down, and it includes closing costs, you can end up going into buying if your credit's good. And if you have that cash flow to support the debt, and end up at a lower monthly cash flow, monthly payment on the debt on the mortgage than you would on a lease. So that's a really exciting thing to really explain to the client. And usually clients who are under 40 million in revenues don't have a CFO. They don't have someone to run these numbers. You really got to help them out. And we as bankers will step up for you. We'll go to your early stage meetings with prospects. We'll help them determine what's available to them. Do their pre-qual? Does their cash flow work? Is the SBA the right product for them and why? And help them see that there's a vision that they can be owners, even though they don't quite understand that they can. What's really important for you guys is to understand the mortgage pitfalls from a decline perspective and also a timing perspective, because there's usually tight deadlines on LOIs, right? So I have in bold and cap there, lack of borrower cooperation on purpose. So our clients love to blame the banks. Oh, the bank's not getting it done. The bank's being difficult, blah, blah, blah. I'm going to tell you that's not the case. They don't get us the documents timely. They're missing documents. They don't disclose key information like, oh, I went bankrupt 16 years ago. Oh, I wrote off a mortgage with a bank after the market crash in 2008. I walked away from an investment property that became underwater, so I screwed a bank. Well, banks don't want to lend to people who screw banks. So we need to ask those difficult questions, and we're very courteous and respectful in the way we ask clients. And we ask them if we can ask them the difficult questions. And that might be uncomfortable for you, or they might not want to disclose it. Well, we'll do your dirty work for you. We'll come to your meetings or talk to them separately and call you back and tell you, we found out your client is not financeable. Run. You're not going to be able to get this deal closed. Don't waste your time. Or we think they're very financeable and this is why. So sometimes the client wants to include you in the conversations, and we welcome that. We'll partner. And if they don't want to, unless we signed an NDA, we will circle back with you and talk to you about the high level conversation piece, just to tell you what the problem is. Like, they have a credit challenge. We can't tell you exactly why, because we have fiduciary responsibilities, but we'll tell you enough to know it's not financeable, or you need hard money, or they don't have the down payment, they couldn't prove it to us, or whatever happens. Fails debt service coverage ratio, that's a real one. So we look at, as banks, when it's owner occupied, what's called debt service coverage ratio. I think most of you know that formula. If not, I always say Google it, but it's, EBITDA or EBITDAR. So earnings before interest, taxes, depreciation, amortization, minus rent, they're going from rent to own, right? And distributions, if they take all the money out of the business, there's no cash flow, right? They took it out. And then we look at the debt service for the new real estate, which is going to be principal and interest payments. We want to make sure they pay their taxes and their insurance, right? They need to keep it working. And that we want that number to be like a 1.25 to 1.3, which is standard in industry, okay? We're teaching you today not about City National Bank's underwriting, but about bank underwriting. So you know this pretty consistent. Now, global cash flow is a different animal. Most banks look at it for owner occupied. And that means that we're going to make sure that the household of the business owners can sustain all the cash flow they need from their business for their family and the business. And that's important, right? Because if the business cash flows because they leave all the money in the business, but then if we look at their personal credit bureau and their personal financial statement, and they have 5 kids and they can't afford what they're doing without taking money out of the business more than they claim they're going to take, they're fudging it. They're trying to get approved and they shouldn't be going this route. So we're going to be really careful about telling you and your client that they are wasting their time, that they're not financeable or they are financeable, and explain to them. So a lot of banks leave people with a bad flavor in their mouth, especially when they say no. They don't explain why it's no. We want to help your clients get financially stronger. We want to help them grow their business and their family wealth. We want to protect them and you. So we're going to give them a little insight. We're going to give them a little financial education with you. They will allow it. And I think it's really helpful and appreciated in the market. You've seen this happen. Property doesn't appraise. Well, we have no control over that, okay? We use third-party appraisers that are approved by the bank. They have the right insurance. They have reputations, good reputations, and they go out and do an appraisal. They use comps. Now, look, if they're not using the right comps or they didn't get enough comps, we look it over and we see that, or the client tells us, we're going to talk about that. We're going to do what we can. But we have no allowance or ability to get them to restate what they think is the right appraisal, and you know that. Same thing with environmentals. Look, if there was a gas station underneath, an oil tank, something else that was there previously, even 40, 50, 60 years ago, you're going to go into the, the environmental, and if it requires a phase 2, we have to do it. That slows down a deal, becomes more expensive on the costs. So we're going to ask the right questions with you first. What was that property perpetuity over its life? When's the last time they had an environmental? Was it clean? And help them and help you to ask. Now, we're going to always talk with you first and separate and apart from your prospect, and then we can get on the phone with them together. But it is important because it does kill deals. So premier trends, I think this is the best topic. What's going on in the market now? Now, we look to you for guidance about what's going on and what you're seeing. That's how we partner. But we also see it not from each of you only, but from the entire market in the entire country. And Josh can comment on this a little later too. I know what's going on in Long Island, Queens, and even the greater metro area where we service from our team. We do deals in New Jersey, Connecticut, Pennsylvania, Westchester, New York City, all the boroughs, Long Island. But that's still only local, right? Some of you might do deals around the country and you want to know what's going on. So what we know from my team that I run is that the banking community is being very conservative. There are some, even through the last 3 months during COVID, weren't lending at all. Lots of banks, and I won't name them. We never stopped lending. We still know what we know. We have confidence in what we know. We have confidence in our underwriting and our guidelines and how we manage our very clean portfolio. And so we continued to lend, but we were always conservative and nothing has changed for us. Some of the banks were not lending, as I said. Now they are lending, and some are being more conservative, as I think they should be. And others are going back to that high risk taking. And those are banks that can't compete in the market. They need to do kind of second tier lending. But those aren't the banks you necessarily want to be with. I'm going to tell you this: if you're in the middle of a deal and the bank sells, the bank's in the middle of M&A, you've seen a lot of that in the market. It can muck your deal up. Banks that go into M&A or in the middle of closing or post-closing will not close deals. They're afraid to do that. They'll only help existing clients and the best of the best. That's why sometimes clients leave their bank when it's in the middle of an M&A. We're seeing high volume. We're seeing a lot of M&A activity. That means people buying other people's businesses, people retiring. COVID really scared people. COVID made people exhausted. They just wanted out. So we're seeing a lot of that. And some it's very opportunistic and great. And healthy companies that hoarded their cash, just like Carl Icahn, are buying, baby. They're buying real estate. They're buying businesses. They're buying partners out that they hate and don't want there anymore. We're seeing family buyouts, succession planning. That's still M&A. So it's pretty interesting. It's a lot of fun. We are over our skis busy, which I do like very much. Demanding deadlines. Everyone, when you're in M&A, you want to do it fast, right? So with the pressure's on. Again, thank you, Josh, for being here today. He doesn't even have this time, but he did me a solid, and I'm happy for it. And as far as, focus changes, I think that people are being very skeptical about what they'll buy and why. And you've seen it. Do I want an office building? Do I want a mixed use? Do I want to buy a certain kind of business that may have gotten really hurt in COVID? Do I want to buy a business or a building that did amazing in COVID and it's going to go away really quick, possibly? So I think there's just a lot of focus change. And I also see that people who never wanted to buy before now are ready to buy because the rates are down, but they're pretty confident they're going up. And maybe Josh will comment on that later a little bit. We don't have a crystal ball, but we know historics, we know statistics, analytics. We listen to our internal, external, people that know about macro and microeconomics. We try to focus on that. Okay, might be having a little bit. Okay, good. So right now I'm going to hand over the mic, and I think just about right on time, to Josh. He is going to talk about interest rate risk management using the swap. Just going to throw this out there. You have his contact info there, but when it comes to origination and questions, you're going to reach out to me, and or someone on my team will service that. And we loop Josh in. He generally is not going to be taking direct calls from the market about swap questions. So with that, Josh, thank you for being here, and let's hear about swaps.
Sounds good. Thanks, Davey. So going to the first page that you have there, what is an interest rate swap? You kind of touched on at the beginning of your presentation about ways that clients finance their real estate loans. From a traditional standpoint, when clients come to banks, banks provide treasury-based loans that have one of two forms of prepayment, as Davey was mentioning, which is what some people call a traditional or 5, 4, 3, 2, 1 prepay. That essentially says if you prepay your debt in any given year, you pay a certain percentage of your loan balance to pay off that loan amount, which is a great concept, but we're finding a lot of clients in this rate environment that has a double whammy, because as rates continue to move higher, since we're in a historically low rate environment, you could have a situation in the future where rates are up, but clients still have a 4% or 3% prepay. So that type of prepayment has its own disadvantages. Also, when banks are providing you these types of loans, that loan structure with a traditional prepay will be the highest traditional fixed rate that a bank would offer, because it introduces prepayment risk to the bank itself, in that we are setting a fixed prepayment for the client, while the true economic prepayment for the bank could be higher than that figure. So more often than not, that will be a higher fixed rate that goes out to your clients. The cheaper form of fixed rate money, as Davey was mentioning, incorporates what's called a modified yield maintenance prepay. And that basically says if we lend you money at a certain interest rate and rates have moved lower since the time that you locked in your rate, since the bank can no longer lend at that same rate, it will be lending at a lower rate, then your client will be responsible for the prepayment based on that rate differential in the market. For example, we lend the money to a client at 4%. Currently, with 5 years left on an original 10-year deal, the current rate is 3.5% for the remaining 5 years that we could relend the money. Then the prepayment is essentially 50 basis points for those 5 years present valued. Typically, with those types of prepays, though, in a higher rate environment, as Davey mentioned, it would either be a 1% minimum or a 0 prepayment owed by the client, which sounds great. And we see a lot of clients who have never done a swap transaction look at that as favorable, that they will not have a prepay. But what your clients really have is an opportunity cost. And what that opportunity cost is that they finance at a really great rate at one point in time. And the reason that they don't have a prepayment anymore is because the current market is pricing the rate for the remaining term that they have on their loan higher than what they locked in. So essentially, that non-prepayment is an opportunity cost that they're not receiving any value for. Now, transitioning that to an interest rate swap and how we use those products to provide fixed rates to your clients. When we provide an interest rate swap to a client, we're providing two underlying agreements to your client. We're providing a variable rate loan, which is City National Bank and other banks' cheapest source of loan funding. And in turn, to provide your clients that fixed rate that they're looking for on their real estate loans, we provide them an interest rate swap, which is essentially us going into the market and letting your clients know, here's where the current market is pricing, for example, on a 10-year period. When your clients agree to an interest rate and fix it via an interest rate swap, The difference between that and a traditional fixed rate is that now it opens up the other side of the market for your clients, so that when they get into this fixed interest rate for a period of 10 years, if interest rates move higher than the rate that they have locked in for that certain period, then we would actually pay them to terminate their swap contracts. So it's the product that really provides that lower fixed rate option compared to traditional treasuries from the bank. But on top of that, it opens up the prepaid benefit that they were not able to receive under traditional treasury products. Oftentimes you'll see when banks are providing various rate sheets to the client, there will be two types of treasury rates as mentioned with the swap. The swap will oftentimes be the cheapest source of rate funding and therefore the cheapest all-in rate that we can provide your client. Davey, are you ready to maybe move to the next slide? Great. So here's a summary of the interest rate swap terms. This is the typical type of deal that we would see through business banking. A $3 million loan amount, 10-year term, 25-year mortgage style amortization. And again, when we do these swap products, we are matching all of the underlying loan terms provided. So whether the bank is providing a 25-year AM, 30-year AM, 20-year AM, the interest rate swap can hedge any cash flow schedule. The floating rate index that banks have typically used for the past 30 years, which a lot of you may be familiar with, is LIBOR. And in most cases, it would be a 1-month LIBOR contract. Well, LIBOR is actually going away and being sunset over the next 2 years, and banks are being advised to no longer lend on LIBOR beyond December 31st of this year. So with that, I'm taking the opportunity to introduce you to the new replacement variable index that'll be the most commonly used in the marketplace, which is the secured overnight financing rate, or what some people refer to in short as SOFR. The differences between LIBOR and SOFR, LIBOR is typically a monthly or quarterly contract, either 1 month or 3 month LIBOR is the most commonly used. SOFR is a daily rate that is calculated and compounded in arrears. But the one thing you'll notice as an end game for your clients when providing an all-in rate is that banks will adjust the loan spread as needed to essentially provide the same all-in rate. SOFR has a slightly different base rate. Typically, it's a little cheaper, but on an all-in rate basis, it would be the same as what you've seen historically. David, can you go to the next slide? So this shows you mechanically on a monthly basis how an interest rate swap works. In this example here, this is for a client who would have had a 10-year swap contract where we told them in order to hedge the underlying loan rate that they have, which we showed as an example of SOFR plus 2%, would provide an all-in fixed rate for 10 years at 3.44% on a swap contract. So mechanically, how does that work? Every month, the client would receive 2 billing statements from City National Bank or their other lender. Now, how this works is the client will maintain and continue to pay the variable rate terms under their underlying loan agreement, which is based on a variable rate SOFR plus their credit spread of 2%. Separately, what happens under the swap, in order to provide that client that fixed all-in rate that they're looking for every month, my department, the interest rate risk management group at City National Bank, sends the client what we call an interest rate reset notice on a monthly basis. And with that, what it shows is the fixed rate that a client agreed to for a 10-year term based on the cash flow schedule, which is their underlying loan amortization schedule. And every month, what my department does is debit or credit a client's account in order to provide that fixed rate between the two contracts. So the way you can think about it, between paying the variable rate on the loan and then the swap contract, which all it does is debit or credit the difference between the variable rate on the loan and the fixed rate agreement that we have for 10 years. Those two payments or debits and credits combined provide the all-in fixed rate to your client. Going to the next slide, you can see how this works when I refer to debits and credits. So in periods where the variable rate on an underlying loan is cheaper than the 10-year fixed rate in this example that a client agreed to, my department in this case would debit a client's account because the variable rate is lower than the 10-year contractual fixed swap rate that a client received. In periods where the variable rate is higher, my department would credit a client's account for that differential because they overpaid on a variable interest basis compared to where their fixed rate is for 10 years. The most important thing for your clients to get, and what every client realizes once they get into a swap contract, is that we match all of the payment and reset terms of the underlying loan. So the debit or credit that I'm referring to as it relates to the swap contract, occurs on a monthly basis, similar to the loan interest payments, and occurs on the same business day. So on a net basis, the total amount of cash that's coming out for the payments under the loan and swap contract are the fixed all-in monthly interest payments and fixed total payments that we provide through mortgage style amortization. And that's the other thing. With the swap contract, we can hedge any amortization style. Primarily with real estate loans, we are using a mortgage style amortization to produce an equal all-in monthly payment, but we also can provide hedges on equal principal payments plus interest, or some type of interest only period. So the cash flow schedule can be customized based on the underlying credit. On the next slide, what we're going to discuss here are some additional differences between swaps and traditional fixed rate loans. We talked about the prepays, that the swap opens up the ability for clients to receive money under a prepayment scenario. But in addition, there's some additional flexibility under a swap structure to discuss that's not available on a traditional fixed. First is the fact that the swap is a separate contract from the underlying loan. It allows us more flexibility during a prepayment scenario. The most common that we would see for your clients would be if a client wants to refinance at some point in the future after receiving their initial loan. With the swap, because it's separate, and when we calculate the prepay penalty, what it allows us to do is if a client came to City National Bank to refinance their debt, we're able to take that prepay penalty, if there is one under the swap in a lower rate environment, and actually build it into the new rate contract that we offer under a swap for the new loan. As an example of how that works, let's say, for example, using this 344 rate that we've been discussing, the client had an existing swap on top of it previously and had a prepayment of $50,000 on their old swap contract. Instead of providing a client a rate of 3.44%, we can finance that $50,000 in one of three ways. We can provide the client more loan proceeds if the loan to value justifies it from a credit standpoint. The client can just simply pay off the breakage costs, which will provide them some tax benefits as far as paying their old prepay. But if the client doesn't have the cash on hand or doesn't want to pay the cash or finance additional debt, then we offer what we call blend and extend contracts. And what that means is that instead of providing your client a 3.44% rate in this example, we would calculate how much that $50,000 is worth in additional interest rate under the terms of their contract. So for example, on a $3 million 10-year term with a 25-year RAM, perhaps that's an additional 20 basis points of interest rate. So instead of your client paying a 3.44 rate and paying a $50,000 prepay on their prior loan, we would show them a 3.64% rate, but that would incorporate that $50,000 prepay so they don't have to come out of pocket for it. We also have additional flexibility that we've seen with 1031 exchanges and other scenarios that could come up over the loan term, and happy to talk about those on an individual basis as opportunities come up. Moving to the next slide, when we talked about kind of the prepay examples, as you can see here, the prepays under the swap, the numbers that are on the top side represent positive values, and the numbers in parentheses represent prepayments by your clients in a lower rate environment. Generally similar to a yield maintenance or modified yield maintenance structure, with the less time remaining under the swap structure, the less dollar potential cost or benefit there will be as you get closer to maturity. But the key thing to look at on this slide, when we talk about rate movement, it's not rate movement in the underlying index, either LIBOR historically or SOFR today. When we talk about rate movement, we're talking about rate movement compared to the underlying swap rate. So when you see rate movement up or down 50 basis points, what that means is that initially we locked in a rate for 10 years. Now we are 3 years into this. So as seen on that chart, 7 years remaining and rates have increased 50 basis points, which means if we were going to go out and offer a client a 7-year interest rate swap contract, that the rate would be 3.94 instead of the current 3.44. What that would mean for the client is if they wanted to repay that interest rate swap and pay off the underlying loan, that we would pay them approximately $81,000 to terminate that swap contract, which represents the client receiving 50 basis points over 7 years on a present value basis. The reason that the numbers you notice there for 50 basis points up or down are slightly larger in a lower rate environment is simply due to present value on the underlying structure. Going to the next few slides, we have some historical rate information here. The first chart is showing historical rate information on SOFR, which is the new commercial replacement for LIBOR. SOFR began reporting data in April of 2018. So it's a very new public index. It is published by the New York Fed. What you'll notice there and what clients sometimes jump to when we talk to them is that spike that you see there in the center of the chart. SOFR is a daily overnight rate that is secured by Treasury transactions. So it's essentially where banks would post, would lend to each other on an overnight basis secured by Treasuries. What that spike was that you see there in the center of the chart was actually related to a short refunding risk that occurred in the market. And therefore the rates on an overnight basis had a intraday spike for that one day in 2019. That's also the benefit of providing an interest rate hedge for these clients, because all those little spikes you see there, there is no risk of those as your client's rate is fixed through the underlying swap agreement. Moving on to 10-year treasuries on the next slide. As we see here, we are still in a very low end of the overall range as we look back over the previous 30 years. Obviously, since the pandemic lows that we saw in the summer of last year, rates have continued to steadily increase, although we've seen kind of a top end sort of flattening over the previous few months. The Fed indicating to about 2 weeks ago that they do intend to sort of move in the timeline for when they expect to increase rates, which is now kind of set for 2 rate hikes by the end of 2023, has put some fear of rising rates back into clients. In the short term, we've seen rates kind of stay steady around a 1.5% 10-year treasury and oscillating around there for the last few weeks. But the general trend is that rates continue to, or most participants continue to believe that rates are moving higher, especially as we move through 2021. How we've seen a lot of clients counteract that for clients who are at the early stage of their underwriting process or clients who have borrowing needs that may come due later this year. We are seeing clients ask for more forward rate lock requests. Now with an interest rate swap, the one difference between that and treasury rate locks is with treasury rate locks, we typically have a shorter window that we can offer them for. Some banks will do them for 30 or 60 days, some banks up to 90 days with a certain down payment or deposit. But with interest rate swaps, it's really unlimited. We've done interest rate swap forwards 3 years into the future, 4 years into the future. It really comes down to where the bank kind of seeks our lending that we're going to do for a client. So if we have a client that we have an agreement with to offer a loan next year, maybe when a previous prepayment comes down, we can execute an interest rate swap for that long in the future. The one thing to keep in mind though with an interest rate swap is because we are putting an active contract in place, and now the date we put it in place, it is rate risk gets introduced even though the effective date may not be till next year. Oftentimes the bank will require some form of cash collateral, or in certain cases we may be able to take other collateral subject to credit approval. And that collateral that we take in the short term is what we use to secure the interest rate swap until the loan closes, at which time whatever collateral we took would be released back to the client. Kind of looking real quick on the next page from a documentation standpoint, we will talk about all this with your clients. There are a few documents that we would have signed separate for the interest rate swap compared to the underlying loan. But one thing that I wanted to point out on this slide is the part about eligible contract participants. Interest rate swaps, and why some of you may or may not see them or use them, are limited to certain financial requirements from a client in order for us to be able to trade. The most common that we will use for your underlying clients is having a borrowing entity with 1 million of net worth or 10 million of assets. And typically with single purpose LLCs, if we're looking at individual real estate transactions, it's simply looking at the appraised value minus the loan amount and seeing if there is 1 million of equity there. We do have other qualifications that we can use for clients. For example, if we have an individual owner who owns 100% of the property, we can take their guarantee, and as long as that guarantor is 1 million of net worth, we can qualify the entity. Or looking for a $10 million corporate asset guarantor. Those are the two most common ways we can use a guarantor to qualify a client as well to do a trade. Also, from a sizing standpoint, more often than not, we are looking at transactions over $1 million for the underlying real estate loan or other loans that we may provide an interest rate hedge on. And predominantly, we're seeing loans in the 2 to 3 million up space just based on a loan to value aspect in order to be able to qualify clients. The process to locking in a rate is pretty simple. We actually provide clients live market live markets in order to be able to lock in their rate. So we're doing it through an actual phone call verification process on a recorded line to have them lock in. And then we follow up with the paperwork after to show clients that their rates are locked in. Here's the summary of terms. But with that, I know we are coming up on 1:45. I want to leave some time for questions if there are any. And Leo, I will turn it back over to you.
Leo, you have to unmute.
Okay, sorry about that. Well,
Yeah.
thank you very much, Davey and Josh. It was great, very informative and very interesting. And Christine, do we have any questions coming in?
Yes, we do. But just as a reminder, you can either raise your hand and we'll permit you to ask your question live, or you can also type in the chat. But to start off with, Davey, how long does it take to get a credit request processed?
That is a great question. And our goal is to expedite. And if the client cooperates and they get us the full package on time, like that slide we talked about earlier with the pitfalls, we can get a loan from receipt of package to closing under 60 days. But that rarely happens because of the client. Or sometimes it's their accountant, or sometimes it's their attorney that they're relying on. We have other clients too and can't react as fast as they want them to. So it really just depends on the client. But if we have to expedite something, I've seen us do it in as little as 45 days, which means approval, appraisal, environmental, title search, and closing, which, as you know, each step takes at least 5-7 days.
Okay, thank you. Josh, question for you. What type of clients are eligible for swaps?
So we kind of talked at the end about that on the final page, but it's really a financial qualification process to start. And then we also do a presentation qualification to make sure that the client understands what they're getting into. So from a financial qualification standpoint, my department will work with any of the bankers that are referring the underlying loan, and we will start to do the process ourselves, looking for that 1 million of net worth in the borrowing entity or 10 million of assets, or if needed, look through to the guarantors and see if we could find a qualification that way. But once we do the financial qualification, for any first-time swap client at City National Bank, we always do a presentation for them. And after the presentation, making sure that the client fully understands what they're getting into, because especially if it's the first time they've done a swap contract. So that's sort of the second part of the qualification. And if we don't feel comfortable that the client understands, we definitely don't want to put a client into a product that they don't. So it's something that we take very seriously, especially when dealing with clients for the first time in City National.
Okay, thank you. Another question for you, Josh, is you mentioned collateral. What collateral would you, what types of collateral are you talking about from your clients?
So typically when we're doing forward rate locks prior to loan closing, we're looking at cash collateral. And what the cash collateral actually is, there's not a set amount. For example, using this deal that I'm looking at here today, what the bank will do is size it based on how much time we're looking at from locking the rate to closing. So the longer the time period, the more collateral we would ask for. But what that collateral represents is actually how much rate movement we want to protect. So for example, if it's a 90-day forward rate lock, we may ask the client for cash collateral equivalent to 50 basis points of rate movement in the underlying deal. And the important thing is it's not a deposit. It's not something the client forfeits. It's just that if, let's say, Davey is providing a loan to a client and we do a forward rate lock and something happens during underwriting or the client decides not to move forward for any reason, we need to have cash collateral on hand to be able to unwind the trade if rates move lower. Assuming the loan closes, that cash collateral is fully refunded. And if terminated, we're only using the portion to cover whatever the market breakage is. It's not necessarily fully surrendered as far as the cash collateral.
Okay. And speaking of underwriting, Davey, what are the typical reasons why credit requests fall apart during the underwriting?
So if you remember some of those pitfalls we talked about earlier, it's often things that the client doesn't disclose, or they don't know because they don't understand bank lending and underwriting, and they don't understand that their business may not be as healthy and strong as they think it is. And we always think our businesses are the best and that they're performing and that, you know, we make a lot of money, and that means we should be able to borrow money or we have a good FICO. But then there's times where the numbers really just don't work. And the clients aren't financially sophisticated. We often see, you know, the CEOs, presidents, and owners of businesses have sales background. Sometimes they have engineering background, but they typically don't have finance backgrounds. And I say typically because some do, or some have educated themselves. Most haven't. So what happens is they think, you know, oh gosh, I make a lot of money every year. I have a, you know, a Porsche, and I have 2 houses and a boat, and I have all this stuff, and I'm rich and I'm great and everything's good. And we go, hey, you can't cash flow on paper the way you do your taxes, the way you do your financials, the way you use your money and the assets you have, but you don't have the liquidity. So you can't get financing. Yes, your business is great and you make a lot of money, but you don't get financing still because of this and this and this. So we really need to make sure they understand these. We really need to have those very high touch. We need to look at the financial to cooperate so that we can help them help themselves, and we can most close deals for brokers.
Okay, thank you. Another question, Josh. When would a swap make more sense than a conventional mortgage?
So I think a swap makes more sense in a few scenarios. One, if a client's holding for full term and they're a long-term hold, a swap will oftentimes be a much better overall fixed rate combination for them. So if a client's motivation is true rate savings, that would make sense. In a general rate environment, this is the perfect rate environment to do interest rate swaps in, primarily because most of the risk as clients are anticipating is rates moving higher. And with that, traditional treasury products don't offer you really any upside potential while they still have prepay provisions in them. A swap has the same prepayment risk as you would see on our modified yield maintenance type prepay, but because of that upside potential, this is the perfect rate environment for them. But also one thing that I did mention at the beginning of the presentation is that swaps also provide a little more flexibility. So if we have a client that maybe wants a 10-year loan commitment, but only wants to fix the rate for a 7-year period of time, we can do a shorter term interest rate swap contract than the full loan term. So we could take into account clients' prepayment concerns, maybe when they look to sell a property, and we can modify that to shorten the period of time that we fix a rate under an interest rate swap. So that additional flexibility, I think, makes it a product that is useful really in any rate environment, but now is optimal.
Thank you. Thank you very much. I don't see any other questions in the chat box, but this is a very big topic, so I'm sure people are going to have to digest it a little bit, and they'll have follow-up questions. So if that's the case, you can certainly reach out to either myself or Leo, but you also had Josh and Davey's contact information, but we'll put you in touch with them. Yeah. And Dan's saying, can you see that to our panelists? Dan says, thank you, Davey and Josh, so much for your time today.
Thank you.
Thank you. And just as a reminder, you know, we are really focused on education. So if any of you on the line would like us to come in person, COVID safe, of course, or virtually to do a presentation to a large group of brokers in your offices, we always welcome doing that. There's no charge, and we're just happy to build a relationship, to build the trust, give you comfort with us, and that, you know, we're going to help you through your deals and help you close deals.
Great, great.
Leo, did I make you an expert?
Better. I'm getting there. I'm getting it. Sink in a little. It's
Good.
kind of a tricky concept to with the swaps.
Listen, I'm a banker 33 years, and I'm going to tell you, I still heavily rely on Josh and his colleagues, and I still have questions because it is complex. But he makes it sound so simple, and frankly, we know it's a great product for now, and that's what's key.
Great. That's terrific. So once again, a great presentation. Thank you very much. And
thank you.
I think we're all good, Christine.
I think we are. Thank you again.
Yeah,
Everyone have a
4th.
safe and relaxing 4th of July.
Absolutely. Happy 4th, everyone.
Enjoy
Have a
the
good rest of your week.
Thank you.
Bye-bye.
Bye-bye.
Bye.
Take care.